we online for the moment. Funny. Okay, so we are 20 online, so I think we will start. So I hope you are all well. I really feel sorry not to be, in Vietnam. It's been this, as we were saying with Tram. It has been the third year we are teaching online. I'm teaching online this course, which is okay. I mean, I think it went well the 2 former years, but obviously it's not exactly like meeting in person. I asked for your position, age in firm, and I see that some have a lot of experience, others less, and some are in banks, others in corporation, non-financial corporation. I would like to share, okay, with you, your environment, what you are doing, and so that we can discuss more easily than with a computer. Anyhow, first, what you have to do, you have 2 computers open, so I can see the chat. But when I will be sharing my screen, please, I think you can unmute your camera. You can unmute your microphone, right? I think everybody can unmute his microphone. And yes, I think so. I let open the fact. So please do not be shy. Anytime I speak and you do not understand, just ask, but do not raise the hand, but just speak, okay? For me, it's an ability to see that you are following, that you're online, that you're there, and to have some interaction on this course. So I think that this is something extremely important. Okay, so maybe, so I hope we can do 3 hours today. Yesterday I was not well, and I went for a COVID test this morning. So I'm not at school. I am in my house at the countryside, where I was over the weekend. I got a test this morning, and I hope I will be, in good shape to teach 3 hours. We will see. Maybe if my voice is not here or if I'm too tired. Right now I'm okay. Honestly, I mean, the night was difficult, but now I'm okay. So, I think I can handle the course today, especially because what I want to do today is to go back on things that you have been doing already, but quite quickly, so that we can make sure that everybody understands the same thing. And so maybe I'm gonna share my screen, so that we can discuss a little bit about the course. And so let's discuss about the course, and maybe before that, first see whether it works. It work now. Okay. So maybe before I start, so the good thing, as I have 2 computers, I can. So please unmute yourself and speak up if you need to discuss everything. So maybe before starting this course about, it's a little bit, maybe at some point we can wait a little bit more, and after the break, maybe everybody can express, we will see, so that everybody tells me a little bit about what you are doing in life. And aside, what I got in an Excel spreadsheet where, I have your position and your age and number of years of experience, which is nice. So a couple of words on me. I'm a graduate from ESCP, and so you will be graduate from ESCP, so we'll be together as alumni of ESCP when you graduate, so you still have to graduate. And so I'm an alumnus from the school, graduating. I graduated in 1988, and I graduated from the school when at the time we had only a master in management. So it was like Programme Grande École. So it was a high school. In order to enter ESCP, you go into a very tough competitive exam. And, the best business school in France are HEC, ESSEC, and ESCP. I mean, HEC is a little bit in front, depends on what you're doing. Like in finance, we're very strong as well. And so the school at the time, I think there was like maybe 1,200 students, something like that. When I was a student there was a finance master program that started. This was the first intake of the master in finance program, I think in 1987 or something like that. And today the school has been growing a lot. You have 8,000 students now at the school, so it's become a big school, very large school with many campuses across Europe. So what I did in life is I started my career when I graduated. So I had many training programs in banks. I was even CFO of a small and medium firm for a couple of months. I mean, it was just, I had fun with that. And then I entered a bank. So I went with the capital market division of Crédit Agricole in France. And in fact, I was working in some VC funds. So I was doing like some VC, but I was also working on, some financial engineering, like share issue, IPO, so very different things. So I was lucky to be in a team that was touching a lot of things, and I was involved in many projects. And, I thought I wanted to know more in finance, and I decided to join the university where I did a banking and finance research master program with, one prominent professor in France who has been advisor to the Prime Minister for 10 years. And so he's now an extremely good friend to me. And, I met him and he said, yeah, why don't you come in my program? Went there. And then I got a fellowship. And after this degree, I went to the US at the University of Rochester, where I was working on my PhD in finance. So, PhD is a lot of work. And when I came back, I was intoxicated by that. And so I decided to apply for an academic position, and I had several offers and decided to go back to the school, to my school that I liked a lot. And so what I've been doing at school over those last years is so I went back to the school 30 years ago now. So it's not yesterday. And so I've been doing, of course, plenty of things. And I've been taking care of the specialization in corporate finance at the school since 1994. So 1994, so it's been like 28 years that I take care of corporate finance track at the school. I was with Professor Chevalier at the beginning. We were co-responsible together of this track, and we and so this track has an extremely good reputation in France. We are very well known. We place our students really everywhere. Goldman Sachs and private equity funds and financial department of firms, and so transaction services, advisory, so everywhere. Even our strategy consulting student, our student that want to work for BCG or McKinsey, they often come and do my specialization because they believe they learn a lot. And generally, when they join McKinsey in Paris or those kind of firms, they're always allocated, all the mission where you have some financial expertise required, they work on that. So I have a long experience. I have a long experience of teaching, and when I taught, I did also research. I was the first in France to work on finance, and I'm certainly one of the first in the world to work on finance labor relation. Like, the fact that, human capital in firm is very important, and there is some connection between what you're able to achieve in terms of investment in human capital and value of the human capital and growth project, investment opportunities, and the value of the firm and the financial policy of firm. So, I did that. I'm still working on that. Today I have like some very important research where I connect, I can write this down a little bit, where I connect leverage with wages. So, I connect leverage of firm with wages. And, what we know from the interaction between leverage and wages is that in the US, most of the evidence in the US was that if you have higher leverage, sorry, I have to get used to that again. Okay, if you have higher leverage, you have higher wages. Okay, and this is generally understood as some kind of risk premium. Okay, so this would be an issue of risk. Okay, if you increase leverage, your employees have higher risk on the human capital, so you will have to pay higher wages. So most of the evidence was in the US, but I had result long ago, 10 years ago more. I observed that, when firms have higher leverage, okay, you tend to have lower wages. Okay, so apparently the effect, the impact of corporate leverage on wages was something different between US and France. And the idea is why. And my intuition was that the difference between US and France, and it's a way to discuss a little bit, to start with, and show you that everything is connected. The difference between US and France is labor regulation. Okay, like in the US, you have one of the most flexible labor market in the world. So it's very easy to adjust labor force, whereas in France, we are not the most regulated market, but we are a well-regulated market in the sense that, if a firm wants to adjust the labor force, unless it is really into big trouble, it's not that easy. That is, it costs you a lot in terms of adjustment costs. And so my idea was to try to elaborate on that, and maybe I will show you some results later. And what we observe, in fact, is that, in fact, you have what we did with one colleague is that we observed that over 24 countries, okay, so we are using 24 countries, and we are using 24 countries with different labor regulation. And what we observe is that the positive effect of leverage on wages is turning negative when the regulation is strengthening. And what we observe is that we observe that in the cross-section, that is to say, when we observe countries like that, corporate leverage and wages association, or when we also look at shocks, that is to say, we look at countries that experience a labor regulation shock, and we observe the impact on corporate leverage. Okay, so just to tell you that, there is some big interaction between finance and many things, even between, HR, labor regulation, wages, the way you split the value in companies. So, finance is not only about, having it right, in terms of cash flow or discount factor, but it goes far ahead of that, and it has to be well thought strategically. So to come back to me before we say something about the course. So, I've been working as a consultant for many large companies. So I never advertise myself. You can look at me on social network. You won't find me, not even on LinkedIn. So, I'm very hidden. I'm a very hidden person, but, some people know me very well and they come to me and, when they need some sound advice, they come to me. And this makes a transition with the course. So what do I do with the firm I advised in my life? What I do, and we are discussing about, the Groupe Carrefour or Kingfisher or, kind of companies like that. Yeah, I work quite a lot with retail companies. And what they are looking for when they come to me is to try to get a fair opinion on things. And what I do, in fact, is I use the theory. So what I do is they have a question. And what I do is I use a theoretical framework to try to answer the question. And then I dig into the literature. So I have like a framework with which I think the framework is what you learn in the corporate finance track or what you learn at CFVG in this program. But I apply that. I know how to apply that, okay, to real situation. And then what I do also is shop around and look in the literature whether, there are some things that are important for me to think about the problem they have in mind. So problem that what a company can have is, how do I, can you look at our capital budgeting procedure and tell us whether what we do is correct, or what do you think of the hurdle rate or discount factor that we are using? What do you think about our WACC computation? Should we own our property or not? And so, any question, okay? And in fact, I don't know everything, but I know how to use the theory so that I have full reasoning, and I avoid to forget about important things when I do think about some issue in finance. Okay, so I'm doing that. So just a couple of last thing on maybe my experience. So, I was hired by the Prime Minister last year. I mean, no, 2 or 3 years ago now. No, getting lost with this pandemic. So 3 years ago, I was hired by as an expert with the Prime Minister to assess a whole set of laws in France. So in France, we have the law is evolving so that the governance of companies is becoming is improving. And what we are doing is that it's about co-determination, sharing the value, bankruptcy laws, etc., etc. So my job there is to assess or to participate to a group and try to say whether the law has the intended effect or not. So, I'm doing that. And I'm doing that freely for the government, but that's a lot of work to assess all that. Okay, so what we will do in this course, and I think that we should move on a little bit. If you look at the syllabus or at the, I remember the last year, for the moment, I haven't heard any of you, but I can remember that last year I had 2 students, and the students, so I have, let me see, there's a chat. Yeah, no, nothing. So last year, some students say, oh, but we already did all that. I say, what I do with you today is an advanced corporate finance course that I do is in my corporate finance specialization, that I do with the Master in Finance specialization. And it's the advanced course in terms of thinking. So you may say, oh, but we did all that already. Yes, you did all that, but you have to rethink a little bit. That is to say, you have to rethink. You have to see, a little bit more how what you learned, you can apply it, or the way you can use it, and rethink a little bit about all that. Very often what you learned are formulas, but you don't exactly know where they're coming from, and you are not completely, you don't have a perfect grasp on using all this theory to apply it in the real world. So the way we do that is, of course, I go back. I need to make sure that you understand things the way I want you to understand them. So I go back on things that you have been doing, but you'll see a little bit differently. These are not the slide of a book. Okay, these are my own way of teaching this stuff for you, so that you have a comprehensive view of corporate finance and the way we do think about many issues, and the way you apply the theory and use this theory, extract the concept to apply it to real situation. So in order to do that, first, exposition of the theory. So we have to go back on that and check what you know and what you don't know, and maybe do some exercises and think a little bit again. And of course, I will convey many messages. So the good thing that the course is now is that you are supposed to have learned that already, at least maybe not everything, but something. So I can insist on messages that are important. Okay, messages that I know are important, and there are many mistakes in the real world. So this is what we will start doing, and then I prepared. We have some exercises, some case studies, so that you can apply all that. And we will see. I discussed that with Tram. I have so the way you'll be assessed is with a large case study that will, in a certain sense, use all what we have been doing through the course. Okay, so you have to go into any single course and exercise to be able to answer. So I'm sure, of course, the limit is that it's a group work. So if one does not do anything, I cannot see it. But at least some in the group have to work and go through the whole course in order to be able to answer. And last year I had some receipt. I had some students that obviously tried to answer the case study with their own, not their own framework, but they fell into all the usual stupid answers that you have in case studies. So you are here to learn more. You are not here just to replicate sometimes reasoning that are wrong. Whereas what I'm trying to do here with you is to debias, to change a little bit the way you tend to assess, or the way we assess in the real world some kind of situation. Okay, so that's a little bit what we are doing. So my goal is first, and if I take just a slide, imagine that. Okay, imagine that you take a company like that. Okay, I take a company, and the company is financed with equity and debt. And here, imagine that you have some real estate. Okay, so you have some real estate here, and here you have some operating assets. And this is a real world situation that we will be discussing. Imagine that you remove that away from the company. That is to say, you have the real estate here and you refinance that on the market. So you go on the market and you get some equity and leverage. And so what you do here is you do a sell, okay, and lease back, okay? What you do here, of course, your operating activity need to use those assets. Imagine that you are a retail company. Imagine that this is Carrefour. So Carrefour was, I don't know how much it is now, but Carrefour 15 years ago when I was working with them, it was like the second retailer in the world. So the turnover was 150 billion euro. And so there was some real estate owned by the firm and, of course, an operating activity. okay, and you have new shareholders, and I won't do everything here, but you have new shareholders coming into the company, and among those shareholders you have Bernard Arnault. Bernard Arnault is LVMH, is was not LVMH, it was Bernard Arnault as an individual, and Colony Capital. And Colony Capital is a company, a US company, so it was the French subsidiary specialized in real estate. And so one day in 2007, March 2007, we learned that they entered the company and take 9%. And this company was listed, of course, and you had like two families that were owning 40%. Okay, so you had two, and then you have other institutional investors, and of course many small investors, shareholders in the company. And so they enter in the company. So we learn. So this was March 2007, and in March 2007 we learned that those guys, Bernard Arnault, LVMH, but not LVMH, but the guy of LVMH that so one of the wealthiest, I think the wealthiest person in Europe now. So he entered the company. He entered the company with Colony Capital, and Colony Capital is doing some commercial real estate. So it's a company specialized in commercial real estate. So the idea was that suddenly they entered the company because they wanted to do a sell and lease back. And sell and lease back is about I sell the real estate and I lease back the asset to the operating activity. Okay, when you do that, of course, does the company need some cash? If you sell, then you have some cash. Do you need some cash? No, the company did not need any cash. So it means that what you do is you buy back some share or you pay some extra dividend to the company. And so you end up having two companies. You end up having a PropCo company owning the asset, and you end up having your Carrefour, who is not owning, that doesn't own any real estate anymore. And this company obviously has been changing quite a lot because there's no real estate, and because now the company has rents, and of course the level of leverage, as you can see, has been increasing. So I just give you this example to explain what we are trying to do in the course. So what we do in the course is use the material you already went through, like capital asset pricing model, Modigliani Miller, option pricing, transfer of value between bondholders and creditors, etc., to assess correctly what we have to think about this operation. At the end of the day, what we are interested in, is able to say, the value of, what's the impact on the value of the company? What's the impact on the value of equity? What's the impact on the value of debt? What's the impact on the value of the cost of capital, of the cost of equity, etc., etc. And at the end of the day, what we are really interested in is, does it create value? Does it create shareholder value? What about the impact for creditors? So all this is what we need. And, at the time, I don't want to open another slide because I'm going to lose this one otherwise. But, in 2007, when this happened, I was working for Carrefour, and I was teaching some executive in Belgium. I was coming back from Argentina and from a trip from Colombia and Argentina because we were teaching all their executive committee in all the subsidiaries. So I think that we did 30 countries. So we taught finance to all the executive committee for 1 year, 1 year and a half. So we traveled everywhere. And I was in Belgium. And I was with the boss, with the CFO of the subsidiary, and we learned about that. And I remember it was 9:30, so we had been teaching for 30 minutes. It was like really the introduction. And he takes me out from the room and say, please do something, go get a cafe. I want to discuss with Christophe. And I went outside with him. And so we discovered the 909% like of those new shareholders entering the company in the listed company, a major company. And then we both saw that, you know, there was something about sale and lease back, or, you know, there was certainly something about real estate. And the real estate thing was about, you know, selling the real estate and leasing back to Carrefour. And I remember that, what this person is actually the CFO of the group. So, like not 20 years ago, 15 years after. So I have to get used to using that again. Can I check how it works? My pencil cannot erase that. Sorry, guys. No. Okay, I didn't use this tablet for a while, so anyway, I want to erase that. Okay, I'm not going to erase anything. So the idea was that why is it that you do that? And the story is that, this person, after 3 minutes, 5 minutes that we discuss and we discover that, and then there was nothing said to the capital market. It's just that we were expecting that those guys may come to do that, because as those investors are specialized in owning real estate and refinancing that and managing real estate, we saw that the way they were having 50% of the capital of these new investor name was Blue Capital. It's always fancy name for things that are not very fancy. And what the CFO of Belgium said, I remember correctly his word. His word was, I'm gonna write it. It's bad. He say, I think it was worse than that. He said it's bad, and then he say, we are dead. That was his word. I can recall that in French. On est mort. So he said we are dead. And, he didn't think as we are dead because, I'm afraid because there are new shareholders. So the group will be managed differently and people may change and maybe there will be a new CEO and I'm friend with the CEO or the CFO and the team will change. No, it was not the story. I mean, the story for him is that we are dead, because what will happen with those new investors is something that's going to be bad for the group. So what he has in mind is that the value will decline. That these new investors coming in the firm will lead to destruction and tremendous destruction of value inside this firm. So that was what he has in mind. And obviously, I don't have the same job as he has, even if I knew quite well the retail industry. I could recall what I said. And what I said, well, you are not on the right track. There's something that is not working. It's going to be difficult. That's what I said. And what I had in mind is something that you will see on the second handout of the course, at the end of the course, where I know from previous studies that if you are in the retail industry and that you have more leverage, your ability to compete with your competitors is going down. So the more leverage you have, the lower your ability to compete on the product market. And why so? Well, why so? Just because, your ability to lower prices your ability to face a price, a war on prices on the market is going to go down. So, what we are discussing here is something about, interaction between the capital structure of the firm and the ability of the firm to compete on the product market. So this is in textbook, but it has to be also in the mind of, investors, managers, and advisors, consultants to firm, okay, when they design those kind of financial engineering, or when they change like that the way companies are financed. So, one operating guy thought it's bad. And what I have in mind is, no, he thought you're dead. And what I think is that it's going to be tough. And then, when I came back to Paris, the treasury manager of the group called me and said, that's crazy. What are they doing? Why is it that those guys come into the company and suddenly what they have in mind is a sell and lease back? So he thought, as we did, that there was a sell and lease back issue. And if there's a sell and lease back issue, he could not understand. And he could not understand for a good reason, is that for 6 months or 1 year, we had been revisiting the idea of should we own or should we lease? That is to say, the lease or buy decision, okay, the lease or buy decision, lease or buy decision is something that we discussed, okay, with all, with the boss of the real estate, with the CFO, with the treasury managers, other people inside the group. And, I was with them into the discussion to think clearly about what is it that we should own, what is it that we should lease, inside the group. And so, there was like really a clear picture of when is it optimal to own, when is it optimal to lease. And suddenly what you have is a group coming and they may decide to lease everything, okay, with a sell and lease back. And so, I remember the guy called me and say, so why is it that they do that? I mean, we cannot understand. We are a large group. We are known to be the best financial department of the large listed firm in France. Why is it that, what do they believe? How can they believe that this operation will create value? And I remember saying to the treasury manager, well, all this is about multiples. All this is about just multiples. And, if I would love to erase, but, for what reason I cannot erase that? This does not erase, this doesn't. Something about. No. Okay. And so the idea was about multiple, but maybe I can just forget about this one and just do another one. So now we are back to a long story, but a long story that will tell you why you have to rethink a little bit. So operating assets, okay, then you have your equity, the leverage, and so you sell the real estate and refinance on capital market. And, like the company, the value of the company was close to 35 billion and leverage was 30 billion, something like that, or 15, or I think it was 50 multiplied, a little bit more than that, actually. So it was, okay, I have to check why it doesn't work on this one. Okay, maybe like 40 billion, okay, and 30 billion leverage. So basically, the company was really more equity financed than debt. And so if you remove the real estate and you get the cash and you buy back or pay a dividend, okay, it means that you have a serious change in capital structure of the firm. So I said to the And so the real estate here is paying some lease. So you have some lease payment to the operating asset, right? And so the treasury manager come to me and say, so why is it that they are doing that? I say, well, what they are doing is using multiples. That is to say, what they're using is they are using multiples to assess the value of the company after and the value of the company before. And they look at value creation, okay, using some multiples. And I'm going to do it extremely simply, saying the following. So imagine that you have two assets in the company. Okay, you have the real estate that would provide some lease payment. There was no lease payment at the time. Okay, like you could imagine that, okay, you receive some lease from your operating asset and you have two divisions and your division real estate is providing lease payment. And then here, okay, you have your operating cash flow minus the lease. Okay, so I do it like that so it's easier to understand. In fact, okay, there was only some operating cash flow on the asset, some asset being owned and some asset being leased. Okay, but I do as if, operating assets are paying lease payment to the real estate. And so, okay, you end up having some, let's say that the free cash flow is whatever. So you have a certain level of free cash flow, okay? And the firm was valued, actually, it was the EBITDA, but no problem with that. So the firm value was that, okay, the firm value was 7 times the EBITDA, or let's say the free cash flow. Okay, so the value of Carrefour, okay, the operating company was 7 times the free cash flow. And, if you go outside and have, a real estate fund like that, okay, so real estate fund is owning some commercial building and then you lease that, well, the value of that, the multiple to value that will be 10 times. And of course, it's going to be 10 times the lease because, you have like a little bit of operating expenses here, but not much. Okay, so let's think 1 second about that. Okay, so the value of the company, so let's forget about, I'm going to call that, just so that it's easier to understand. Let's say that the company is valued 7 times the operating cash flow. Okay, just so that, lease, okay, here the lease plus cash flow, operating minus lease, equal to operating cash flow, okay, and 7 times. So the company was valued, so before, okay, the company is valued 7 times the operating cash flow. And after, well, the reasoning goes, well, you bring the real estate to a company, the valuation of this company will be based on the free cash flow of this company, but the free cash flow will be the lease payment, the future lease payment minus some operating expenses that are really small. Okay, so, and basically is going to be, and given the valuation of this company on the market, well, you're going to be valued lease 12 times the lease. Okay, so what you have here is the real estate that you bring inside a specific company will be worth 12 times the lease. And what about the Carrefour? Well, you don't have that anymore. Okay, so what you have here is just cash flow, operating cash flow minus lease. Okay, and Carrefour is valued 7 times, so 7 times cash flow operating minus the lease payment. Okay, so if you look at the situation after and you do after minus before. So before 7 times cash flow after 12 times the lease and 7 times cash flow operating minus the lease. If you do the after, okay, so if I do the difference after minus before, what do you get? 5 times the lease. Great. Great. Actually, the reason why Bernard Arnault decided to go in this venture is because he had this exposed by his former head of strategy at LVMH and an investment banker. And he thought it was a relevant idea. So my treasury manager goes to Morgan Stanley in Paris and meet, one of the financial analysts and ask him, I tell them, but go see someone in the industry, in banks, and ask him why they are doing that, the way they assess the operation. And the guy goes like that. And he say, we observe, so we expect 1 billion, 2 billion, 3 billion of value creation, extracting the value. And from March 2007 to June 2007, I was able to find 50 analyst report that would make reasoning along the same lines and observe between 500 million to 30 billion value. 30 billion value. So basically, not a single note, not a single analyst note was saying that this operation will not be good for the company. So they all had in mind that this operation would create value for the company and for the shareholders. So on one hand, an operating guy, CFO of the company, say we are dead, and me, experienced professor with a lot of knowledge, academic knowledge, and having thought a lot, with company, I think is bad. Okay, so we are dead. And then on the other hand, using those kind of reasoning along those lines, okay, and using multiples, many analysts on the market and many observers tend to observe value creation between this sell and leaseback operation, right? So there's something bizarre, okay? There's something that, we have to reconcile. I mean, you cannot have on one hand, like some academics that believe something and, and like some guy inside the company, and the guy was a very experienced person as well. He was young, but he was really good. And he had a lot of experience, and that we do have, very different thoughts about value creation behind an operation like that. So what do you think? Don't be shy. You're not forced to unmute. You are not forced to open your webcam, but you can unmute your microphone. I'll be happy to hear one of you. So what do you think about what's on the screen now? So, you all know what multiples are, and, EBITDA or free cash flow or operating cash flow. And you understand that what I'm saying here is that you have a very large company, and, the company is worth 7 times the free cash flow, EBITDA, operating cash flow, whatever. And then you split apart the company, reshuffling the assets, and do some sell and lease back. And because the asset is more valued on the market, then you create value. And so this is what, financial observers of this had in mind. I can tell you that, many people were looking at that. Many people were looking at that all over the world, because, of course, when something like that happens to the secondary retailer in the world that operates in 50 countries, it may mean something for the whole industry. That is to say, maybe the whole industry is going to, be differently managed, or, the way it will be organized will be different. Okay. So what do you have in mind? Do you see any? I mean, what I'm asking here, and I like to see if there is at this stage some critical thinking on that. Is there something that seems to be a little bit too easy behind that? It's 7 times the free cash flow, and then 12 times the lease, and 7 times free cash flow minus the lease. So I reap 5 times. So when I say I reap 5 times the lease, meaning that meaning that's the value creation. So it can be a lot. Huh? So what do you think? Is there something that? What's wrong? What's wrong? Okay, so there's something wrong. If I thought it's bad, and if this guy think they're dead. I mean, if this guy believe they're dead, obviously this is something really bad for the company. And between bad and good, there is neutral. Okay, and how come from the outside people see that as a good operation, and from the inside of the company, or me as an outside observer, I see that as something extremely dangerous as well. So first, what's wrong behind that? Well, what's wrong behind that? Okay, what's wrong behind that? And I observe, I mean, I don't know whether you're all well connected and all listen carefully, but I think the biggest mistake here, okay, the biggest mistake here is here. Okay, if you remove the real estate, then the multiple of valuation of Carrefour won't be 7 anymore. Why? You have to think correctly. If the multiple here is 12, is because those assets here, the real estate is less risky. Okay, so here you have less risk. Okay, those assets here have less risk than the operating activity. The way we look at Carrefour is, say, you have real estate and you have operating assets. Okay, but the real estate, if it's valued more on the market, is because, behind the multiple, I'm going to write it here. I don't have much space here, but multiple is going to be something correlated with 1 divided by K minus J, where K is the cost of capital, is the discount factor of the assets that we are looking at, and J is the growth rate. The growth rate on the operating activity and the real estate will be the same. But if you have 12 here, is because the lease payment, the volatility of lease payment is smaller than the volatility of the retail operating activity. Okay, if you go and look at some variable on the market, and you look at beta, for instance, of real estate company, or you look at the beta in the retail industry, well, the beta of real estate is lower than the beta of retail. Why? Because the volatility is lower. Even during the COVID shock, even during the financial crisis shock, okay, people were paying their lease payment. Okay, so there's very low volatility behind. I'm not saying that there's no risk, and there may be some risk at some point, especially when you have a real estate crisis, but at least the volatility of lease payment is lower than the volatility of operating cash flow. So what happens here is that I'm going to leave that here. Sorry, I'm just going to open that. So what I'm saying here is the volatility on lease, okay, is lower than the volatility on operating activity in the retail industry. So what does it mean? it means that the beta here, okay, the beta of your real estate company, okay, the beta here of your real estate company, that the cash flow would be this payment, okay, is lower than the beta of your retail activity. So what will happen here, okay, is that the K here, the K of your real estate company, of your PropCo company, okay, is gonna be lower than the one on the operating company. Okay, and if this is the case, okay, what happened is that the multiple here will be higher than the multiple that you have here is higher. Why? Because the multiple is something like 1 divided by K minus J. It's something very easy to understand. You know, a firm value is going to be the free cash flow. Imagine that, you know, the free cash flow is increasing at a continuous growth rate of J. Okay, the value of the company is that. So it's not complicated to see that, okay, if you just write this down like that, okay, just put it here, and V over the free cash flow is A1 minus 1 divided by K minus J. So if the risk is different and the cost of capital is different, then the multiple will be different. And that's why here you have 12. Okay, so now why is it that Carrefour, so the multiple of Carrefour used to be 7? Okay, so the multiple of Carrefour used to be 7. Why is it that the multiple will decrease? Well, just because you used to own real estate, you had an asset that the risk was lower than the operating activity. The other way to see that is to look just at that, okay? Like the volatility, you have a certain volatility. So what we are interested in now is the operating cash flow and the lease. And you have a certain level of risk, and here you have a lower level of risk. So what is happening if you subtract from a variable cash flow, a cash flow with a lower risk? What happens is that the risk is increasing. So what I'm saying here is that the level of volatility of the cash flow when you pay the lease is increasing just because the lease is more fixed than the operating cash flow of the firm. So all this will say that, you know, after the sell and lease back, what we would observe is that there will be an increase in K. And if K is increasing, the multiple is decreasing. So what does it mean? It means that the whole reasoning that, you know, multiple of Carrefour was 7 times and multiple of Carrefour will remain 7 times. Okay, so here you have operating cash flow minus lease 7 times, and then, okay, you have 5 times the lease. You have, okay, so you have 12 times. So you have 12 times the lease. I don't know why it's not working on this one. To check that. Okay, no, sorry. So let's go back. Sorry. So let's go on that, huh? So operating cash flow, okay, multiply, firm was valued 7 times, and then you split, okay, and you say lease multiply by 5, and you say operating cash flow minus lease, and you say multiply by 7, and what I say is wrong. Why? Multiply by 12. Okay, multiply by 12, and operating cash flow minus lease multiply by 7. And so what's wrong here? Well, what's wrong is that it's not 7 anymore. Why isn't it 7 anymore? Because this company is owning the real estate and you have some operating cash flow and there is a certain level of risk. But what I'm saying here is because you remove from a variable cash flow some lease payments that are fixed, okay, you increase the volatility. So the volatility of this flow here, okay, is higher than the volatility of the operating cash flow. So if this is 7 times, this is less than 7. Okay. And so it means that the whole reasoning that was done by financial analysts on that was wrong. And the advice that was made to Bernard Arnault when he thought about doing that was wrong. And so it means that there is, and it was 207, but now you can see the same type of stupid reasoning going on. Like there is another retailer in France called Casino, and a couple of years ago, not long ago, like 2018, okay, company was running into some kind of difficulties, and I could see some analysts saying that, well, if they do a sell and lease back, then it will disgorge the value and the value will increase, etc., etc. And they had the same kind of reasoning because they forget about the risk. Okay, so what is it that you need to understand correctly that? That is to say, why is it and why is this course called Advanced Financial Management, whereas apparently what we're doing is going back to the basics. Yes, going back to the basics, but making sure that people really understand how to apply the basics. It's not only about knowing what the beta is, it's about, being able to understand the firm as a portfolio of assets. Okay, so the mistake that was done. Okay, the mistake that was done here is really that you have some real estate, you have an operating activity. Okay, behind that you have a certain beta. Okay, behind that you have a certain beta. If you remove this one, then the beta will increase. And if the beta will increase, the cost of capital will increase. Okay, and then, of course, if you have here some cash and you remove, what happens here is that the leverage is increasing. So why is it that the leverage is increasing? For many reasons. One of the reasons is that the shareholders that come here, the shareholders that come here in this operation, Bernard Arnault, I don't know for Colony Capital, but he has a lot of leverage. He has 90% of debt. That is to say, if you take 10%, 5% for each shareholder of something worth 40 billion, okay, that's a lot of money. It means that 2 billion for Bernard Arnault. But 90% of that was leverage. So it means that, look at that. Okay, leverage, more leverage. So leverage has been increasing because you remove some equity here. And where do you have leverage also? Lease. You have to pay lease, payment on the operating activity. So leverage, leverage, leverage. So you go from a very conservative financial structure to a capital structure with a lot of leverage. And how does it work for the industry, the retail industry? Very bad. That's what I had in mind. Okay, because the business model, the business model in the retail industry is like that. Okay, so this is the time. Okay, and the business model. So this is the price on the market. And what happened on the retail industry? You have a war. Okay, so either you have a war on prices. So either you do that, either you are the one that initiate the war, either a competitor does. But if it's you, it's because you can push up prices lower, and so that later on you do acquisition of customers, and then what you do is you can increase your price again, etc. So prices are like that. And the CFO of the company, when he say we are dead, okay, what did he have in mind? What he had in mind is that if you put rents here, if you have rents here, so imagine that it's not the price, but these are the operating cash flow. Okay, so you have all the other expenses aside the lease, and what you do here is you have lease or you have your lease payment here. And so what you do is you're dead. You're dead because you are unable to compete, because you are unable to face a high level of competition on a market that is extremely competitive. And especially it was in Belgium, that was a very competitive market, and price was extremely important. So he knew that all it would be bad. So to say a story short, and as an introduction to why we are going through, going back to the basics and think again, capital asset pricing model, valuation model, Modigliani-Miller, option pricing applied to capital structure, and then go into financial strategy. And so you'll be redoing things that you've been doing, but doing that differently so that you become better. And better meaning that you're more able to have some critical thinking about all that, and then learn how to apply that on example, on exercises, and then do a case study so that you improve on your ability to make sure that you understand. So all this is extremely important. So if you look at this case study, I mean, there is really two stages here. You have two stages. The first stage, imagine that I have this here, this is a demand, and Bernard Arnault asked me what I think about that. First thing I will do, okay, is I will use the theory and say, well, if you are real estate, you sell the real estate and lease back, it won't create value. The sole thing that you will do is reallocate your assets, okay? The sole thing, so what I'm going to use here is use Modigliani-Miller, use capital asset pricing model. And what I will say is that, unless you're able to show that the free cash flow is increasing, there's no value creation. Okay, so I'm sorry, that thing about just opening. So the two stages, if I summarize, the first stage is to do Modigliani-Miller plus capital asset pricing model, okay, and say, well, the sole thing that you do here is you allocate assets differently, and you allocate risk return differently. And you have to avoid the pitfalls of multiple valuation and saying stupid thing because you do not understand. So Modigliani-Miller and capital asset pricing model is really to think well about risk return, okay, of asset, risk return and valuation of asset on markets, okay, in order to say correct thing about all that. And so this would be the second. And the second stage would be to do exactly what we do in the literature. Say, well, but there may be some tax issues, and there may be some agency issues. So what are agency issues? For instance, well, if you increase leverage, if you increase the leverage, if the company leverage is increasing, then maybe there will be a reduction in the value of the existing debt. And if the value of the existing debt is going down, so maybe it's going to be good for the share price. So, like for instance, if you increase the amount of leverage, then your debt holders will be penalized. And so the market value of the debt will go down and the share price may increase, right? So, there may be some tax issues around, there may be some agency issues, but then there may be other things like, what happened when the impact of leverage is increasing on, for instance, market competition. Okay, and this is exactly after 2 minutes what I had in mind, because I knew from previous work being done on that each time a company becomes more leveraged, the price of product is increasing in the retail industry. If a new competitor enter in a market and other firms are LBOs, it's easy to enter, etc., etc. Okay, so you see that what I do, and we are discussing about big business. We are like that, not discussing about small business. We are discussing of important thing here. That, like Carrefour was 500,000 employees. We are discussing. So, this story made me crazy a little bit because, you have like people entering in a company for bad reason. And at the end of the day, it's a disaster. It's a disaster. The stock price of the group went from 57 to 14. That's the value creation that the financial analyst expected from that. So were they right? No, they were completely wrong. And what happened was exactly what the theory was saying. That is to say, you had some transfer of value, you had some huge problem of market competition, you had some transfer of value, you had some, you had many implicit contracts that were not honored in the company. So when you have more leverage, your ability to fulfill your implicit contract with your customers, with your suppliers, with your employees is going down. And this may be very bad for the value of the company. So all what we expect, okay, in financial theory, if we use that seriously to look at that, happened in this case study, okay? So this is a little bit the goal of the course is, to make sure that, you understand those mechanisms and have a good grasp of those mechanisms. And you don't need to be a company with 500,000 employees for this to apply. If you take a company with 50 employees, you have the same issues, exactly the same issues. So, there's no, of course, when you are a listed company, that you have stocks listed, that you have bond listed, that you are observed by bond market and financial analysts, etc. Things are different because markets will tell you what's the value of what you're doing. Like there is some reaction of the market to what you are saying, what you're doing. Okay, but it's the same for small firms. Right? It's not because you are private, it's not because you are owned by a private equity group or that you have private debt, that the mechanism that we are discussing are not exactly the same. So it's going to be exactly the same kind of thing. Okay, I hope maybe COVID, I will let you know if I have the COVID or not. Apparently, I'm not in too bad shape. Do you have any question by the chat or... No? Okay. So if there is no, but you can always interrupt me. So maybe before we do a small break, I hope I was like, it's the beginning of the course, but so this is not the whole course content. There's more to that. There's a second handout. This is the first thing that I want to do. First thing that I want to do is, for me, understanding that is extremely important. If you don't understand that, or if you have a limited understanding of that, you're dead. You cannot work in corporate finance. I'm serious about that. That is to say, you will be on the side of the people that will say stupid thing with the case study we discussed before. And obviously, at ESCP, what we want is train people so they have critical thinking and they're able to understand and avoid mistakes. So we will discuss, and we will discuss that after the break, risk return and capital asset pricing model. We'll see how far we go. I hope we can be fast. I don't want to be, I think that I will tell you things that you have not heard. Okay, so it's a brief summary, but I think that I want you to understand from scratch the basics and see how far we went and then play a little bit with the concept. Second thing is very important in the case study that we saw is to understand the firm as a portfolio of assets and then apply the capital asset pricing model to understand, if you have two assets, okay, if you have asset A, B, C, and you have some cash, okay, and okay, so you have a structure like that. What's the cost of capital of the company? I'm not talking of the WACC, okay? The WACC is something related to the liability side of the company. I'm talking on the asset side of the company. The cost of capital is something that rewards the average operating risk on the asset side of the company. So imagine that I have ABC plus cash. So what's going to be the cost of capital on the asset side of the company? And in order to understand that, you have to really well understand the capital asset pricing model and how you use the capital asset pricing model to on firm valuation. Then I'm not doing a valuation course, even if I'm quite good at valuation, but I will tell you sorry. I will tell you about foundation of valuation model and the cost of capital determination. So you can say, oh, we all know that, etc. No, you'll see there are a couple of things that you have to have very much in your mind. In particular, what I will tell you is that, when you do think about valuation, you have to think in terms of convergence, meaning that, the models in corporate finance are meant, and the different valuation models are different approach to a value, and those models are converging. And you have to understand the links between dividend discount model, free cash flow model, multiples, etc., etc. So we'll discuss that. And then we have, and it's not that I love that, but I let that in the slide. Okay, work back on Modigliani Miller, capital structure, irrelevance proposition, and demonstration, proof of that, etc. I will go quite quickly on that. But again, I have some case studies so that I'm sure you understand profoundly. Okay, you understand, at the end of the day, if you're good in finance, you're able to explain to a CEO or to your grandmother that does not understand anything to finance, you're able to explain. Okay? Someone that understands finance is someone that is able to, to really, explain easy things. Not easy things. They are not easy, but explain in easy terms, some complex mechanism. And I can say that the way leverage impact value, the way leverage impact cost of equity, cost of capital is not well understood. I interact with many professionals, and their view on that is still low. I mean, like Modigliani Miller is 1958. So 1958 is long ago, very long ago. And despite it's very long ago, I mean, plenty of people in the real world, in the finance area, still do not understand very well. Whereas these are the physics law of finance. I cannot really say it, but I have a pencil here. I'm not gonna throw this pencil. I'm gonna throw, what can I throw? This, okay. If I have this and it fell down. Nobody imagined that if I do that, it will go in the sky. Okay, so these are law of physics. If you have some debt on an asset, you will always have the same thing. Okay, so there are things that are behind the risk return of asset and etc. that will be the same whatever the company, whatever the asset, that you have to well understand. And what I observe is not well understood. I see a lot of professionals that are using all day. They are using, for instance, things like beta of equity. Okay, is beta operating 1 plus D over E. Okay, so they are using that. Sometimes they are using that when they cannot use it. But anyway, so they are using this kind of thing. And at the same time, they say Modigliani Miller is theory. So they say, oh yeah, but Modigliani Miller is a perfect world and it's theory. And then every day they are using leverage beta and leverage beta, etc. But what you have to know is that this is Modigliani Miller. Okay, so this formula here is just Modigliani Miller. If you don't have Modigliani Miller, you don't have this formula. Okay, so that's what we will be discussing a little bit. That I will go back on that messages is capital asset pricing model and Modigliani Miller. And then we'll discuss a little bit dividend policy and quickly. And then we'll go in capital structure and option theory. So I think this is new. I mean, I'm not sure that you do a lot of that. In fact, you'll see that option pricing is a fantastic tool to assess the value of what? Well, in fact, you can value the company A, B, C, cash, etc. And this, you can use the capital asset pricing model for that. But then when it comes to sharing the value between equity and leverage and be able to assess the correct value of equity and leverage, then option can be extremely nice. That is to say, because we will see that equity is like a call on the firm value, face value, strike price being the face value of the debt, etc. And so the idea is to use option pricing, and there are two important things behind that. Valuation, so it will complete, okay, what we have been saying with KPM, Modigliani Miller. Option pricing is really the tools that you need in corporate finance to avoid making errors. And also because when you do that, you are able to understand more about conflict between equity holders, debt holders, etc. And so we will discuss, option theory, we'll discuss convertible, we'll discuss, etc. And you'll see that I know you know what convertible is, but you'll see you will learn a lot of things. Maybe quickly on that before a small break. I don't want to go too fast. And I insist on that. Mastering theory is everything. Okay, it's not everything, but in finance, you have to understand discounting, you have to understand free cash flow, you have to understand ratios, etc. That's not complicated, but what's really complicated is really avoiding mistake. Be able, to have the reasoning at a certain level to be able to say smart thing and avoid problem. Okay, and when you look at the history of corporate finance, okay, before the 1950s, it was really institutional, normative. There was no serious background theory. And the serious background theory was really Modigliani Miller capital asset pricing model, okay, in the 50s and 70s. Okay, and the other thing that happened, okay, so it seems to be long ago, but it's still having a large effect on the world today. So what I'm saying here is that still not very well understood. The Carrefour case study tells you people did not apply correctly basic finance. That is to say, the assessment of this operation was done without taking into proper account of the basics in finance, which is really a problem. Okay. Second, what happened in the 1970s with agency theory, problems of information, etc., okay, is that we understood the firm as a set of contract. So a firm is a set of contract between shareholders, bondholders, managers, employees, and we start to think about financial policy. We start to think about corporate finance as a way to lower those contracting costs. So we really thought about, conflict of interest, etc. And this really lead to a very, very powerful way of looking at finance. So, all this was about shareholder value principles. All this led to shareholder governance. Okay, so this was the shareholder primacy was built beyond that. Okay, so shareholder value, shareholder governance. Why is it that stock price is something that you can rely on to have target for managers in a company, etc. So all these flow from that. Okay, so it's very important to rediscuss that. And so where are we standing today? So basically, many countries, the US, European countries, to some extent, Vietnam today, okay, are very much into some kind of, Vietnam certainly still a little bit in between, but are very much in a shareholder primacy view and maximization shareholder value and shareholder value target being something important. Today, where are we? Today, in finance, we are in a better application of the existing tools. Okay, I won't repeat, we've been saying that, but too many mistakes still today. So still need to refresh, still need to think, still need etc. I think maybe certainly one of the reasons for that is that you have many courses in finance that are not good. Too many courses in finance that are too globish, it's too you do not have deep content. You just like too many slides, too many formulas, not enough thought. So people are not well trained and they end up making big mistake. So I think that, we have to take time. Finance is not that easy. So we have to take time to explain, etc., not do too much and make sure that the basics are well understood. Okay. I think that's really important. And what we are today is also, I think that we are having plenty of ideas between, corporate finance and key determinants of firm value. So, how does, implicit contract with your employees interact with your financial decisions? How does your capital structure and market competitors interact? And then you have also the issue that I won't tackle a lot in this class. Okay, you have now all the issue. Okay, I'm invited to a seminar at 5 p.m. after this class. All the issue of climate change, externalities, how does it relate to capital structure, corporate finance? For me, today, there are already many papers not very well digested. I mean, today I think that we still have to seek more. I avoid teaching too much about that because I believe that there's a lot of blah blah on that, but it's still not very clear. Okay, what should be taught, and what we have to really catch up with all that. I don't think it's settled yet. So to finish that so that we can enter KPM, I look at the time, it's 3:30. So if we want to save 1 hour, 15 minutes, because obviously we all need a break. And what you have to have in mind, but I think introductions are important. I don't know whether I was clear or not, but I cannot see that from your face. But theory and practice are very tight relation in finance, okay? And for instance, you have, for instance, risk measure, okay? So risk measure and discount factor, valuation, therefore capex, etc., etc. So all that is completely grounded on theory. Second, but there are other things that you have to understand where theory is extremely important. Theory has a lot of importance on regulation. Okay, bankruptcy laws are not the same all over the world. Takeover laws are different among the world, but the lawyers are being influenced by studies being done in corporate finance. Okay, so for instance, we're able to look at different way of doing okay, like when you have bankruptcies of firm. Okay, you are not bankrupt the same way in France and Germany or Great Britain. And what is good, what is bad? Okay, is that better that we always have shareholders coming after, or do we have some time to avoid the bad priority rules? All this is extremely important. And we do have plenty of studies that look at that, and corporate finance is influencing a lot the regulator. And then you also have a huge impact on corporate devices, instruments being used, and strategy. For instance, if you think about stock option, or the fact that you compensate managers based on the stock price, or you attribute shares, etc., which is widely spread in many countries today. In France, in all companies listed or even unlisted, okay, managers do have shares, or do have some form of compensation based on the value of the shares. And all this is flowing from theory. Okay, if there was not Jensen-Meckling 1976 that say, well, we have to align, okay, managers and shareholders, okay, then there won't be this kind of instruments and this way to compensate managers. Okay, so it has tremendously influenced, even outside the finance world. I mean, outside the finance decision, but also like issues of compensation. And last thing I want to say is that, in fact, the theory has a profound impact on the way the market tend to think about an operation. And I don't want to go too far because we will discuss that later, but think about the issue of diversification. And I'm just going to stop with that. So should a firm be diversified or not? Well, if I summarize the step, but I will make it clear, I mean, on some extent, because it's important to well understand that. And there are some important things behind that. In fact, long ago, that is to say, before the 60s, you had many firms that became conglomerate. And you had many conglomerates, you had many companies operating in a lot of industries. And what was it that was behind that? Well, just this. Okay, if you have two, so you are in a risk return framework, and if you have two uncorrelated and perfectly correlated assets, okay, if you set a portfolio of two activities, so here you have a chemical activity and here pharmaceutical activity, and if you're able to make a portfolio like that, what you have is a risk of your asset that is lower. So the idea that, well, it's good to diversify because the risk is going down. And so if the risk is going down, maybe the cost of capital will go down. So the idea is that if the risk is going down, maybe the cost of capital is going down. If the cost of capital is going down, the value is going up. We don't even need that. Like risk is going down, it's going to be good for many people, but also for shareholders. So, what I'm saying here is that how the theory influenced. Before the 60s, we saw that conglomerate has value on the market because of that. And then the first step in terms of improvement of the theory was the capital asset pricing model. And the capital asset pricing model, what did it say? Well, what the capital asset pricing model say is that the cost of capital of the firm is going to be the average, weighted average. Let's say that, okay, each firm here is 50%. A and B have the same size. Okay, what the capital asset pricing model applied to corporate finance will say is that the KAB, the cost of capital of the two companies, will be the weighted average of the two cost of capital. What does it mean? It means that this intuition is wrong. Okay, the cost of capital is not decreasing, and so the value will not increase. So what the capital asset pricing model is saying indirectly, the implication of using the capital asset pricing model to value companies is that the firm value will be the same. Third, as you know, do capital markets like conglomerate? No. That's what certainly you have in mind. Okay, discount, holding discount and discount on conglomerates, etc. Is that always true? No. We observe some discount on conglomerates in developed capital markets. We do observe sometimes some premium on conglomerate on other markets. I do not know about any study being done in Vietnam, but in India, there were studies being done by two Harvard professors revealing that conglomerate is more than the sum of the part. Okay, so like the conglomerate discount is not everywhere. But anyway, why is it that the firm value is lower? So basically, what we had in mind is value is higher. Then capital asset pricing models say, well, no, in fact, it's not true. We should not expect a higher value when a firm is diversifying. okay, because there was some kind of mistake that here we correct. We have to discuss about that. And then, there is the idea that maybe you have in mind that the value is lower. So why is the value lower? Well, the value is lower because you have agency problem. Okay, because you have agency and you have information problem, and they are related. If you operate in 5 industries, okay, it's difficult to benchmark, okay, the conglomerate with pure players. Okay, what the capital market like is be able to understand, what's inside the company. If you have a company that operates in 5 industries and, those companies have links between themselves, it may be extremely difficult for the capital market to disentangle all that. And you may have agency problems. You may have conflict. You may have managers that are not doing the right thing in those companies. And you also have information problems. That is to say, the ability for the capital market to assess exactly what's going on in the company is lower. So that's why, that's the story that today, we tend to have when we do think about conglomerates, that we know those conglomerates should split because, it will extract the value, because you will resolve some agency problem, information problems. There's no reason a manager is not good in all the industries. So it's better to split apart those conglomerates. So this would be the story. And what I'm saying here is how the theory influenced the way you assess operation. Fourth, what do we know since the financial crisis? Since the financial crisis, we know that conglomerates are doing better than pure players, okay, are doing better than pure players in shocks. That is to say, when you are in tough times, financial crisis, COVID period, whatever, what was observed by some researchers is that, when the equity price declined by 50% on pure players, it declined by 30%. Okay, it declined by 30% on conglomerates. That is to say, conglomerates help you avoid too much loss in the equity price on capital markets on average. And what those researchers are doing is they are taking a company, a conglomerate A plus B, and then they benchmark with A prime, okay, A tilde and B tilde, and then they observe the drop of value. And what they observe is that this is declining more than that. Okay, so there's more drop in value in conglomerate. There's less, sorry. Wrong. Should stop. It's okay, so there is more drop. So the drop in value here on pure players is higher than conglomerates. So conglomerates help you, okay, avoid too much drop in value. And why is it so? Well, maybe because you protect financing, because risk diversification allows you to protect the value of the more fragile asset in shocks, etc. There are many reasons for that. Okay. And what I want to say here is well, right. First, understanding KPM, how it affects is something important. Now, when it comes to this story, that's a story. I focus on governance issues, information issues, and I say, well, a firm should split apart. And then I may have an opposite view. And the opposite view is that, conglomerate would be better because of resisting better in shocks. And what do we understand? Well, what we understand is that maybe tomorrow, imagine that we go from one crisis to another crisis. Imagine that governance issues may be very important back 20 or 30 years ago. Are they really a problem today? Not that much in developed market. Why? Because, managers are so much aligned with shareholders that we don't believe that, managers have really governance issues today. There may be some governance issues, but at least there were so many things being done so that managers are, working for shareholders that we can expect that they are not, that they are quite aligned with them. On the contrary, maybe we are in economies that are going from one shock to another shock. Financial crisis, sovereign debt crisis, blah, blah, etc., pandemic, war, oil shock, etc., raw material increases, all these are shocks. And so maybe what we will consider, okay, is that shock is so much important that, and we understand that conglomerate can protect value in shocks, that maybe we will rediscover tomorrow the value of those conglomerates. Okay, so this is a little bit what I wanted to tell you as an introduction, is that theory is not about two formulas. You have to understand what's behind the formulas, how to apply them. Okay, make sure that you're able to explain finance to someone that does not understand finance. Okay, and then the way to train is to look at rethink about the theory, use the material, do exercises, train yourself on case studies, rethink about all that. Okay, and then understand that after that you have many powerful ideas, thoughts, theories that help you think about what a company should do. And this has profound implication. This has implication on regulation. This has implication on what a company should do. And this also has implication on what the financial markets think of a firm. And then when I think as a financial market on a firm of what a firm should do, then it has implication on what the firm is doing. Okay, so I think all this is extremely important, and you have to think well about all that, right? Maybe I'm gonna stop here. I was saying that I would do only like yeah, you're here, and I would do only like 1 hour and then stop a couple of minutes. So what we do now is we make a break, and I mean the session is recorded. That's bad. So maybe we should. No, I wanted to show you a video at some point, but if it's recorded, I cannot. No, it's an interesting video of a company did in finance. I think it's nice for you to show it. I never show it, but let me see. Yeah, maybe we can. Yeah, maybe we could pause on that, huh? Okay. Okay. So there was a question about the documents. En français, hein, if you want. Are you back or not yet? Time on not too long, but still there's always more to say. So I want to go back to. So I've been losing you here. Oh, too bad. Okay, so I don't have a camera anymore. My fault. No, sorry. No, I just want to reconnect my. I don't know why I was ejected, so I just want to reconnect on this computer so that I can see if there is any question. Big blue button in progress, join, and here I am. Okay. Yeah, right. It's good so that I can see So still 38 connected. So I don't know how much active you are, the 38, but 38, not bad. Okay. So objective of the course, but very quickly. So revisit and master the basics. It's very essential. Risk, firm, valuation, modeling Miller. Apply option theory to value. Hold a second. I have an echo here. Okay. And apply option theory to value firm financial securities. So this is going to be new for you. I think that the first is not going to be new, but the way I use it may be new for you. And so I have a case study based on that. I mean, several small case studies and a case study you will have to do to be able to use that correctly. And then option pricing, and then there will be a second handout, and the second handout will be about more financial strategy and things that we've been saying on Carrefour, but say many stories grounded on corporate financial policy and strategy and all what we can imagine and think in terms of relation. Okay, so let's go back to the basics, because I said basics are important. And first, risk and KPM, a brief summary. And of course, I know it's not like you have the feeling maybe that's the beginning. Yes, it's a little bit the beginning, but it's the beginning, quickly, so that I make sure that you are very clear on all that. So risk in finance is about being able to expect some uncertainty in cash flows and be able to associate the probability to those cash flows. Okay, and apparently I have a problem here. No, okay. And so distribution of cash flow, okay? So distribution of cash flow and associated probabilities. And those probabilities can be objective or can be subjective. Okay, subjective meaning it depends on your assessment of the market, the level of competition, etc. And objective would be, for instance, if you have a machine, and you can have the machine can break down with a certain probability, and it takes you 1 week to fix the machine, and so you lose some production, so you can have some objective probability. Of course, the risk that we are discussing is in 99.9% of the case, you assess subjective probability to risk. Okay, that is to say, the ability to say, I have a probability of 1 out 1,000 to have a machine that is breaking down is really a small part of the risk. So many risks are risks that exist, but for which we do have a subjective assessment of the risk. And, so if I take like two assets, A and B, for which the expected payoff in 1 year are 105, 115, or B, 1 and 130. Okay, the idea here would be so what is taking into account the level of risk? Well, the idea would be, okay, imagine that I give you that or that. That is to say, you have the choice between A and B. Okay, what would you prefer? I thought there was a question here. I don't see the question. So the question would be, what do you prefer? Maybe I erased the question. So do you prefer A or B? You can say in the chat. Imagine that I give you, I tell you, well, you have the choice between A or B. Which asset do you prefer? Well, I'm sure all what you're all doing that, okay? 110 and here 115, and so B is giving expected value which is higher than A. And so maybe some of you may say, well, I prefer B. Okay. At the same time, the difference between A and B, and I don't want to be too long on that, but is that you lose 5 when times are bad. Okay, so you can think of that as times are bad. When times are bad, you lose 5, but you earn 15 more when times are good. So, when times are good, you have 15 more, but when times are bad, you have 5 more. So, the dispersion is higher for B than for A, but the return is higher. So, what's interesting is that, if you were discussing, think about that, just to have fun 1 minute on that. Imagine, okay, someone said B, right? Some may say, but, thank you. So if you say like 115, let's take, hold a second. We open this is very important because this is behind what you have behind asset valuation, right? Let's hold a second. Understand what you do when you value a risky asset. Okay, imagine that you have A, and A is 115, and B is 105. Okay, and then you have B, but B is not the one that we have before. B is 0 and 500. Okay, so I give you the choice between, okay, I give you that. Okay, I give you an envelope on which there is A or B. And you know that A is going to be probability 1/2, 115, probability 1/2, 105. And here it's going to be 500 and 0. And question is, what do you prefer? It's possible that most of you will say, I prefer B. Let's say that. Why? Well, because if you have B, you have $500 or 500 euro. Okay. And so, well, it's fun. Of course, you may lose 100, but having 500 is nice. But let's, yeah. Someone said A. Good. So someone said A. Good. Imagine that now you add a 0 on that. Just think about that. Well, if you have a 0 on that, what will happen is that we may lose a lot of people that were preferring B. Yeah, it depends. But the problem is it depends. You will see why. So the idea is that if B is giving you that and A is giving you that, and what I just did is add a 0 here. I just add a 0 here. And what we will do is that we will lose a lot of people that would prefer B. Now they would prefer A. And if you add another 0 here, I just add a 0, okay? Then, many people will say, oh, if I'm sure to get more than $10,000 that you give me, that will pay for my program, or I don't know, or I get 50,000 euro. Well, some may prefer, if they are more wealthy, if they are more risk lovers, if they are less risk averse, let's say, they may prefer the 50. Okay, but most of the people, if people are honest, they will go for that. And if you add still a 0, etc., then everybody, even the most wealthy guy in the world, okay, or the less risk-averse person in the world, they will go for A. Yeah, B is more volatile than A, right? I understand. But what is a valuation model? What is a valuation model? A valuation model is something that I have the value of A, okay, and I say the value of A has a certain value and the value of B has a certain value. And how do you assess this value? And so what does it mean? It means that if I give you A or I give you B, okay, and if the value of A is higher than the value of B, everybody is going to prefer A. So what I'm saying is that if you look at choices of individuals in risky situation, okay, they may prefer A, they may prefer B. If you had some 0, they may turn from B to A, etc., etc. But at the end of the day, evaluation is be able to set a price on future cash flows with uncertainties. And it means that there's something extremely bizarre here, that, it seems that making decision in an uncertain world is very much based on things that we have inside our body, but at the same time, okay, we're able to assess some value, okay, that will not depend on what people are doing. In fact, what we will do is just say that the value of A is going to be the value of A. Imagine that this is in 1 year from now, the value of A is going to be the expected cash flow discounted at the appropriate discount rate. And VB is going to be 115 discounted at KB. And KB, if 115 is in 1 year. So valuation model is going to be to assess the expected cash flow at the appropriate discount rate, taking into account the level of risk. But when you do that, I want to make sure that you understand that when we do that, apparently we do something that is a little bit different than when we were choosing between A and B. I mean, if A is better, okay, if I had a 0 year, okay, A still will be better. Or if B is better, if B has more value than if I had a 0, B has more value, and I should not turn from B to A. So there's something here that has to be understood. And there is in the capital asset pricing model, and there is in the way we assess risk in finance, and we set a price on risk in finance, things that are very important. And why do I insist on that? I insist on that because if you are among the executive committee in a company, if you are a board member, if you are trying to think for a company about allocating some money on asset depending on the level of risk, of course, those kind of things may interfere. That is to say, you may have individuals that have preferences for risk. And at the end of the day, me as a finance person, I have to be able, to take some weight on all that and say, no, given the level of risk, we should command a certain level of discount factor that will give you a certain value, independently of your risk preferences. Okay, we will have to understand that. Okay, so let's move on. So suppose both assets have the same market value, 100. So the sole thing I did here is so what I just did here is transform my payoff into return. Okay, so A will have 5%, 15%, and B 0 and 30%. And what is risk in finance? Well, risk in finance is associated with the volatility of the expected return. Okay, so expect the return volatility, future return volatility is something that will matter with risk. Okay, so if I just write down something that is important, is that just wrote that down before, is that the value. Okay, so if I take an asset like that, okay, so the value of the asset, okay, the value, so if I had let's say 105, 115, 110 on average, well, the value, okay, the value of my asset will be, so imagine that the value today is 100, so the value is 100, and 100 is going to be 110 divided by 1 plus 10%. So think about that, 5%, 15%, expected return 10%. So the value of the firm is the expected cash flow discounted at the expected return. Okay, so I have 5% return, 15% return, and this is my expected return. And this is the value of my asset. Okay, and the fundamental relation is that any kind of asset on the market, the value of any kind of asset is always the expected cash flow discounted at the expected return, but the expected return is the required rate of return. Okay, and the required rate of return depends on the level of risk. Okay, but I'm going to make sure that you understand well what makes the level of risk. Well, what makes the level of risk is like 5%, 15%. So here I have 10% average. So it means that my volatility is going to be 5%. The standard deviation will be 5%. And why is it? And what makes and of course, this volatility is making my level of return. This is my expected return, but my expected return is also my required rate of return. But what makes the expected return the risk? But what makes the risk is the volatility of the return. But the volatility of the return depends on what? On the payoff and the value. Okay, so there is kind of a circular relation. Okay, the firm value, the value of the asset depend on the expected cash flow, but the expected cash flow have a certain level of risk given the value of the asset. Okay, so there is a circularity here, and I will give you a case study that you will have to work on maybe for next time, or we will see where we end up in 37 minutes. Okay, so this is the way it works. Expect cash flows. Value is about cash flows, discounted at a required rate of return depending on the risk. Okay, but the risk depends on the volatility, but volatility depends on the return, and the volatility of the return that depends on the price. So everything is very circular here. Alors, let's have fun and take a small example. And we combine 70%. No, we don't combine for the moment. Yeah, we can combine, but right now we don't know. Yeah, maybe we combine. We will be combining afterward. Now I look at the chat. Okay. Example, value of a bond. Imagine that the asset that we are looking at is a bond, and the bond value, okay, the bond value is 100. So you have a bond value. The price of the bond today is 100, and the face value is 115. But there is a 50%. This is the probability of default of losing 10, meaning that the bond is worth 105. In 50% of the case. So it's a risky debt. Okay, there is risk expected by the market on this debt, and you may lose 10 with a certain probability, 50%. So at the end of the day, the payoff is 115 and 105. Okay, so we are back to A. So this is the same asset as A. How do you value a bond? Okay, first way to value a bond, you say, well, 100, the value of the bond is 115. So 115 is it's a zero coupon bond. Okay, so the sole payment you have is 115. So is 115 discounted at 15%? Okay, and what is 15%? Well, it's your yield to maturity. Okay, right? Second way so is that the previous model? So is what I write here, is that the previous model? No, it's not the previous model. The previous model is that is 100 is 110 divided 1 plus 10%, with 10% being the expected return. So 10% is the expected return. And now I have a question for you. I know as all students in finance, okay, you love WACC. You love. And I will show you in this class that to compute WACC correctly, especially when you have taxation, but not only, is nearly impossible. And very often, it's not you have a lot of problem computing the WACC. And there are ways to do that are far more clever than going through a WACC. But I know that as all students all over the world, WACC is always something that you have in mind. I'm not against WACC. I'm saying that very often you cannot compute it. And you have to do something else. But anyway, imagine that, as you know, the WACC is KE, E over E plus KD, 1 minus T, D of taxation, D over V. We'll discuss that. Okay, so my question here, the question I have here is KD. So is KD 15% or is KD 10%? You can answer in the chat if you prefer. 15. Thank you. Any other opinion? No? I was expecting this answer, but that's not the correct answer. See? Slide number 10. Huh? It's not the correct answer. KE is the required rate of return. This is the expected return. KD has to be the same thing. KD is on average, how much do you expect me as a bondholder, if I buy a bond, how much do I expect? Well, what I expect is to get 15%. Okay, what I expect is to have 15% in good state of the world, but to have 5% in bad state of the world. So in fact, what I expect here is 10%. So the cost of that, okay, the cost of that will be 10%. I mean, 15%, what is 15%? 15% is the cost of that. This would be the exposed cost of debt if no default. You understand? So 15% is what you will get if there is no default. But you get 15%, which may be a lot, because there is default expected, and you may get 5. So the idea is that, so here is something important. If you want to assess correctly the WACC of a firm that has some debt with risk, the cost of debt that you have to take into account is not the yield. The yield is obviously something that is more easy to have, but it's not the yield, but is the average return that you expect on the debt. And otherwise, you make a big mistake because you may end up, the problem is if here you take the yield to maturity and here you take the expected return, you may end up having a yield that is higher the cost of equity, which does not make any sense. If you think today of some high yield debt, not even very high yield, but you may have 7%. And at the same time, KE for many companies can be like 6%. With 1%, with 1%, risk premium 5%, risk-free rate 1%, it's completely stupid. You cannot have a debt which costs less than equity. Equity is more costly than debt. Okay, so there's a mistake. But thank you for the answer. So the cost of debt is not the yield to maturity. The yield to maturity is what you get in case of no default. And what you are interested in is the expected return. And if I go a little bit further, I don't write it here, but we can open that. So imagine that, KD is going to be 10%, the yield to maturity will be 15%, and imagine that the risk-free rate is, let's say, 7%, okay? So if my risk-free rate, meaning that KD minus RF is going to be 3%, and this is a risk premium. That is to say, this is over the risk-free rate. How much do I expect on average? This is the expected return on my debt. And the RD minus RF, okay, is going to be 8%. And this is the spread. Okay, so risk premium, spread. Two different concepts. Okay, and the expected return, okay, the expected return on the debt, the cost of debt, expected return equal cost of debt is going to be 10%. Okay, and exactly as, the cost of equity, okay, the cost of equity is an expected return for the equity. Okay, so watch that. KD expected return gives you a risk premium yield to maturity. So I will provide in the, I tell you, everything we will say during the class, at some point you will have it. You will have in the assessment that you will have to do, at some point there will be a risky debt, okay? So there will be a debt with risk, and I will ask you to compute that, and I will ask you to compute that, and I will ask you to compute the beta. So exactly like all know what the beta is, okay? So ERD is the risk-free rate plus the market risk premium multiplied by beta D. Okay, so if you look at the beta of the debt, okay, if you assess leverage beta, then the leverage beta will give you the expected return of the debt. Okay, and not the RD. Many problems, we are only at slide number 10 or whatever. Already for that, many mistakes. Many mistakes. People are not clear between, what's the cost of debt and what's the yield to maturity. So that's why I know you learned that, but I know that there are a couple of things to be resaid on that. Okay, let's move. Application of the mean variance criterion. Okay, so I don't want to, so I'm not doing, because I could spend 6 hours on that, or 9 hours, or 12 hours. So it's just and I don't know exactly how it was done to you, but still I need you to just I want to see some kind of small picture so that we can play with that. Okay, what we know is that when we are in correctly functioning capital markets, okay, we are able to assess an asset, and I think that this is something important. In fact, any asset like real estate, oil, whatever, any asset in an efficient capital market can be assessed by the knowledge of the expected return and the volatility. Okay, so that is to say, if I go back to my example here, okay, so imagine in my example here, so it means that, okay, the expected return of A is 10% and the volatility is 5%, and the expected return on B and the volatility is 15% and 15%. Okay, what I'm saying here is the knowledge of the return and the return on the risk makes me completely able as an investor to assess those assets. Imagine that I am an investor and I want to invest in real estate in Europe. And I go to a professional, okay, an asset manager that is managing some assets in real estate. I do not need to know everything. I do not need to know, what is the outcome, what's the impact of the crisis, how will taxation change, if times are good, no. What I need to know in order to understand the value of those assets for me is what's the return, what's the risk, and what's the correlation of the asset to the market. That is to say, to the other assets I am considering to have in my portfolio. I don't need more information. Okay, and I'm going to go quickly on that. I don't want to spend too much time on that, but the idea is that you perfectly characterize an asset, understanding if you have asset I, you perfectly characterize an asset having two information, the return and the volatility. But in order to have the return and the volatility, you have to have the expected cash flow, you have to have the value of the asset in order to be able to compute both. Okay, and then how does it work, finance, in this world? Well, it works like that. You are in a risk-return framework, okay, and you have asset A and you have asset B. And here, I guess you all did some economics. or you did that even here. Here is an indifference curve. What is an indifference curve? Well, an indifference curve means that, okay, if I am an investor with this risk aversion here, characterized by this indifference curve, it means that, indifference curve means that I'm indifferent between 1 and 2. That is to say, on one indifference curve, I'm indifferent between those two assets. And of course, if I have an asset here, 3, I'm going up. That is to say, I'm reducing the risk, increasing the return. So I prefer, I would prefer 3 to 2 and 1 because I'm an indifference curve that is higher than the former U1 and U2. Okay, and if you look now at U tilde here, so it's more flat here. The curve is more flat. So what's the difference between U and U tilde? Well, the difference is that if you have the curve here, in order to have, when you take the same risk, if you increase the volatility, you will increase the return less. Okay, so this is more flat. So as this is more flat, when you increase the risk, you increase the return less. So this would mean that if I am this investor here, I am less risk averse. Okay, so here I am risk averse, here I am risk averse, but I am less risk averse. And what we can see, and it's very interesting to look at like that at asset pricing and preferences when there is some risk. If I do that, is because in certain corporate finance situation, it's nice to have this in mind. Well, hold a second, because I have to know why I have a problem. I used to be able to erase. I cannot anymore. I changed computer. Okay, so what happened is the following, is that, this is what you can do. Okay, what you can do is you have assets that give you cash flows, that have a certain value, give you some expected return and some risk. And this is what you want to do. What you want to do is be on the indifference curve that is the highest. Well, what you could observe, is that if you have A, you are on this curve. And if you have B, you are on this curve. So obviously, A, if I am U, UA is over UB. So you will choose asset A. And if you have U tilde, I'm not going to design it here because it may be a little bit less clear. But if you have U tilde, well, you can see that maybe you are a little bit over. So let's say that B is chosen. So depending on your risk aversion, you will decide to have A or to have B. Again, I play with that and we'll jump to some corporate finance exercise, just to see how much you think about all that and you are able to use that. So, what I'm doing here is like, I jump from 1 century. It took time to understand all that. Demand for liquidity with different risk aversion. Tobin, 1952, the Nobel Prize of Economics, and the real father of portfolio theory. So Beer portfolio theory, before that you had Tobin. And Tobin has a contribution which is extremely interesting, where he says, imagine that you can allocate your wealth between a bond and some cash. And the difference between the bond and the cash is that the bond has some risk. The risk that is interested in is interest rate risk. So if I invest in a bond long term, I may experience some losses. When I resell the bond, I may experience some losses on the value on my bond. So, I'm going to... and so there is some volatility on the resale value of my bond depending on the future interest rate. Whereas I do not experience that with the cash. And what he shows and this is the first time he showed, he said, well, if you combine, and this is something important, very important, if you combine a risky asset and a cash, what you do is a set of portfolio that is like that. Okay, so this is the set of portfolio. So imagine that I have some cash and I invest in a bond a little bit. And if I invest half of my bond, okay, if I invest half of my wealth, in a bond, my level of risk will be half the level of risk of the bond, and my return will be half of the return, okay, with the cash giving 0% as return, okay? So the idea is that, okay, that if I combine, okay, I am on the line, okay, I don't provide all the maths of that. But if you combine cash and bond, you do a set of portfolio like that. But what you observe is that you will increase the level of return, but you will increase the level of risk. And this is proportional. Is there any risk diversification? No. If I combine a risky asset and cash, there is no risk diversification. Risk diversification means that the risk, I combine A and B, and the risk of the portfolio AB is lower than the weighted average of the two portfolio, of the two assets. This is risk diversification. This is risk diversification. Okay, here there is no risk diversification. If I have 50% of cash, 50% of bond, I have a risk that is half of the risk. It's a line. Here it's a line. Okay, it's linear. So if it's linear, means that if I combine the risky asset and the cash, I have exactly a weighted average risk and a weighted average return. Okay. Now, even if there is no risk diversification, is it interesting to diversify the portfolio? Answer, yes. Yes. Interesting. Huh? That is to say, what I'm saying here is that the risk is equal to the weighted average of the risk. So no risk diversification. But is that optimal to diversify the portfolio? Yes, it's optimal. Why? Because if I have this indifference curve, I'm here. If I have this indifference curve, I'm here. So I jump from a portfolio with less cash to a portfolio with more cash to a portfolio with less cash. So depending on my risk aversion, I won't have the same portfolio. So why is it optimal to diversify? So what Tobin here is revealing, it's a whole story. The story was why do investors, the story I had in mind is why do investors have some cash when bonds will give you higher return? Okay, and what he revealed is that it's optimal for all investors to diversify between cash and bonds. And the level of diversification will depend on the risk aversion. Okay, and so there's optimality of having a diversified portfolio here between the risky asset and the cash. And what's really important with this simple figure is just to highlight the role of cash. What cash is doing is that if you have a risky asset and you make a portfolio of this risky asset with cash, you can modulate, okay? You can play both with the level of risk and return of your portfolio. So that's something extremely important about cash. Okay, corporate finance. Exactly like, I always go back to some issues in corporate finance. Imagine that a firm has cash invested at the risk-free rate. And okay, look at the question. Okay, let's open a figure. Imagine that, let's do that like that. So, okay, so imagine that the company has an operating asset and the company has a huge amount of cash. So you have 2 billion of operating. The average average level of cash of companies. I have data in France and all over the world. Average level of cash is like 10% of total assets. Okay, so it's a lot. Companies overall have a lot of cash. Okay, in the US, 12%. So imagine that you have operating asset, and I want to listen to you or in the chat. Imagine that, here my operating asset is giving me 10%, and so it's 2/3 of the value, and cash is 1/3, and cash is 0%. Meaning that my return is going to be my operating return, that would be also the cost of capital of the company, is going to be 6.66%. Okay, I have some cash that gives me nothing, and then I have this value of the company that gives me a return of 10%. Or let's say that gives me something. Okay, let's be nice. Let's say 3%, just for sake of. Okay, so 3% will be, so it's going to be 6.66 plus 1, 7.66%. Okay, so I have 2/3, 10%, and 1/3, 3%. So I have 7.66%. And my firm is 100% equity financed. Okay, no leverage for the moment, meaning that the expected return for my shareholders, which is the cost of equity, will be 7.66%. So that's what I expect on my return. Okay, so I have a portfolio of assets. So my company has a portfolio of operating assets plus a lot of cash. Okay, and then my equity holders, on average, expect 7.66 return. Okay, sometimes we do hear the fact that, well, the problem is that cash is lowering the return. That is to say, my idea is to do, well, if I were having a company like that and like that because I use the cash and I buy back shares on the market, and then, I will have 10%, and then my equity return will increase and be 10%. Okay, because, then my expected return for my shareholders will be higher. My question is the following. Imagine that the cash is correctly rewarded for the risk that you take. That is to say, 3%, okay, is a correct return for the risk being taken, okay, on the cash. Okay, so it's correctly rewarded for the risk brought by this cash to the company. If I remove the cash, okay, so here is, I do that, okay, I remove the cash, I buy back or pay dividend, and then this is my company at the end of the day. Question, will the share price increase? You can unmute, or you can unmute, or you can unmute, or you can answer in the chat. What do you think? It's related to what we said before. What I'm pushing you to do is to think in terms of risk return. When you think about risk, you think about return. When you think about return, you think about risk. What will happen to the risk of shareholders? What will happen to the risk of shareholders? It will increase. If you do that, okay, what will happen? Okay, so I do it here smaller. Okay, you have your operating, you have your cash, you have your equity, and you turn to that, the operating equity. What you are doing actually is exactly that. So what you are doing here, yeah, of course. What you're doing here is exactly that. That is to say, you have your operating asset. Okay, your operating asset has an operating risk. Okay, and you have the cost of capital of your operating asset 10%. And today, sorry, so no, it's not exactly, that's 3%. I hate that, sorry. I have to make sure why I cannot erase because I cannot make a sole mistake. Okay, so let's do it again. Okay, so here I have the risk. Here I have the return. We have the 3%. We have the 10%. Okay, so this is the cash. Okay, this is the return on the operating asset. This is the risk-free rate. Okay, and what we have here is the operating risk. Okay, and what we have here is something like that. Okay, so what we do have here is the following. Is today 1, 2, 3. Your company today is here. This is the risk of the stock. So this is the risk of E, the stock before. And this is your KE. So KE here is 7.66%. And what will happen if you remove the cash is indeed you will increase the return. Okay, but what will you increase as well? So it means that KE, which was 7.66, will become KE tilde equal to 10%. So KE is increasing. So it means the expected return is increasing because the cash was lowering the return. But what will increase as well? The level of risk. So the idea is that the value of that, the value here is not higher than the value here. The sole thing that you do, okay, removing the cash is increasing the risk and the return. So that's the reason many companies own a lot of cash. Cash is not a problem. Okay, cash, then it's another story. The other story is to say, let's think 1 minute about cash. I'll look at my watch. So we have 5 minutes left. We will finish on that. I mean, I prefer that we spend some time to discuss. So what I'm showing you here is that you always have to think about, okay, these are basic things. Okay, I have some cash with no risk. I have an operating asset. If I have some cash, then on my asset side, I would have something that would have lower return but lower risk. Is that better or worse? It's the same. It's neutral. The fact that you have cash is lowering the return, lowering the cash. It's no big deal. So the idea is that the level of cash that you will have, in a theoretical perspective, tend to be neutral on the firm value. Now, why can it be positive, the level of cash? Well, if you have many investment opportunities, okay, and cash is good because it's easier to finance investment opportunities with cash. If you are in a complicated capital market, if access to finance is limited, etc. Okay, or on the contrary, you can say, well, cash also has some drawback. For instance, cash is negative because you have agency problem. If a manager is sitting on a lot of cash, then maybe he's not very productive. So, on one hand, cash can be good because I can seize investment opportunities that will create value. Okay. At the same time, if I have a lot of cash, I may not run the firm very efficiently because I have so much money that, I'm not forced to be extremely productive or thinking well about, doing better what I am doing today. So that's the story about cash. There are issues that why is it that some firms have to have some cash, why others won't have that much cash? Then there is also a risk management issue. Cash is something important to manage your risk. I mean, the best way to handle some risk that you have to have in the future, maybe to have a certain level of cash. Okay, so that's here the story. But what I'm saying is that someone that will tell, oh, cash is lowering the return for shareholder than destroying value, wrong. Okay, because you have to understand that this was your initial situation, this is your situation after. Okay, level of return increase, but level of risk increase. Okay, and okay, now imagine that someone says, and no, I cannot remember the second question. Yeah, the second question is, imagine that a widely held firm declares paying out a dividend to satisfy the demand for liquidity for its shareholders. Is that possible? So what we are saying here is the following, is that some shareholder, okay, you say, me as a manager, I say, look, there is some cash, this is the stock. So if I pay some dividend, I give some cash to my shareholder. So in fact, giving a dividend is splitting the value between the value in a risky asset and the value in cash. And what I'm saying is that paying a certain level of dividend is having a certain portfolio. So if I pay more dividend, I will give more cash to shareholders. And a widely held firm declares paying out a dividend to satisfy the demand for liquidity of its shareholder. Is that possible? Answer, no, not possible. If you are a widely held firm, you don't know your investors. You don't know their liquidity needs. You don't know what their utility functions are. You don't know whether they are risk averse, not risk averse. And on top of that, what Miller and Modigliani will tell you is that you can construct the level of cash you want selling the shares. So even if you have a non-dividend paying stock, so you have a stock that is not paying dividend, you can create your own dividend selling a share of your stock. If I want 20%, if I want 10% dividend, or if I want 5% dividend, if I want a yield of 10%, I can always buy non-paying dividends and sell 5% of my portfolio, and I will have a yield. So companies that will declare that they construct an optimal dividend for all their shareholders, it's not possible. What you can do, of course, if you have a family-owned firm and the family needs a certain level of cash because behind you have many people that are living with the money of the company, this is different. But we are not saying that you can construct a level of dividend that will be optimal for everybody. Okay, so see how some basic things of finance are very important to avoid mistake. Like the story that cash will destroy firm value is wrong. Cash is neutral on firm value. Decrease the return, decrease the risk. Then then you can have positive stories and negative stories on cash. This is different. But first, we have to understand correctly. And this is likely like the Carrefour case study. What we try to do first is use correctly the benchmark to say something correct. And saying something correct is really about being very strong on risk-return principles. And I look at my clock because I know it's 10 p.m. So it's been long. And it's the first course. So it's normal that we get to know each other. I would not say this because I haven't heard you a lot. But So we will meet on Wednesday. Huh? Hopefully, I won't have the COVID. I should have the result. I look pretty good, apparently. So, you know, at least it was good. It was good meeting all you. 39. Perfect. 39. At least you're all registered. Okay. Any question before we? So, no, what you can do? No, I don't expect that you may do a lot. Okay. We'll go next time. We'll go quickly into that. Quickly. If you want, I will encourage you, you know, each time I say, oh, there's an exercise, there's something to do, I'm encouraging you to try to do it. So it's a small exercise on, you know, it's just building, it's just building, you know, the, if you have a stock A and stock B, okay, or 1 and 2, how do you construct the curve here, the portfolio, the set of portfolios that you can construct with 2 stocks? I don't know whether you can do that. I would be curious to see if you're able from this. So you have a stock 1 and you have the return and the return of 2, and you compute mean and standard deviation of R1 and R2 and the correlation coefficient, and then you try to construct the curve. I'm wondering whether you know how to do that. So A and B is easy. So you are like in, this is the return, this is the risk, okay, and this is the return of A, return of B, so return and risk. So from that, you're able to assess the risk return of 1 and 2. And then what you do is you do a portfolio that combines A and B. So here, if I have B, and here I have 90% of B and 10% of A, etc., etc. And you can combine a portfolio to get the return and the risk and be able to construct this curve. I don't know whether you've done that or not. I think it's nice to do it. So try if you want. And second thing that you can do, you'll see I give you the demonstration of KPM. So it's nice to see that. Because in textbook, you only see that, but you don't know where it flows from. And you can start looking at that if you want. Okay? So we will do that next time. I think we have to spend, you know, on risk return, capital asset pricing model, before applying that even to corporate finance, I think we have to spend 6 hours. 4 hours and a half is the minimum. Okay, any question before we leave? No? Okay. Okay, see you Wednesday then.